You can become a small owner of companies like Apple or Tesla simply by investing the monthly price of a pizza. Plus, with the proper method, you can grow your savings as you never imagined. In today's video, I will show you how the stock market can become your ally in achieving your financial goals. So get ready, because this video maybe could change your life. Hello everyone, and welcome to this new video. Here is the winning journey. Today, we will discuss a fundamental topic for those who want to approach the world of investments: the stock market. What is it? How does it work? And above all, how can you choose the right shares to build a winning portfolio? Keep watching this video because, in the end, I will reveal 3 strategies based on 3 different sectors, and you will have a clear and practical overview of how to start your journey in finance. Or, if you are not new to this world, some of this information may awaken a winning thought. Anyway, let's start from the basics. What is the stock market? In short, the stock market is a place, physical or virtual, where shares owned by companies listed on the stock exchange are bought and sold. Companies go public to raise capital. By selling shares to investors, they obtain the funds needed to grow. And we investors, what do we gain? We can get dividends, participate in company growth, and earn from the shares' appreciation. There are 2 main segments in the stock market. The first is the primary market, which represents the segment of the financial markets in which new securities, such as stocks and bonds, are issued and sold for the first time. Here, financial instruments are created and placed directly by issuers who raise capital from investors such as companies, governments, or other institutions. Among the main features are publishing new securities at a fixed price established by the issuer, raising funds to finance projects or expansions, and direct transactions between issuer and investor, often mediated by banks. Issuers, institutional investors, and in some cases, individual investors participate in the primary market. Typical examples include IPOs, initial public offerings, issues of new shares for capital increases, and bond issues. The primary market allows the direct flow of capital to the issuer, playing a crucial role in the economy. It promotes business growth, finances public projects, and facilitates the transfer of financial resources from those with a surplus to those in need of capital, contributing strongly to overall economic development. Instead, the secondary market is that part of the financial world where financial instruments, such as shares and bonds, are exchanged, which have already been issued in the past and are already in circulation. Unlike the primary market, where securities are first created and sold directly by issuers, investors buy and sell these securities among themselves in the secondary market. If a person purchased a stock when it was first issued, they can resell it to someone else right in the secondary market. Here are the main characteristics of the secondary market. As already mentioned, exchanges between investors. Here, the original broadcaster is not involved, and exchanges happen directly between those who want to sell and those who want to buy. The value of securities changes continuously because it depends on supply and demand. There is great liquidity. We must remember that this market offers investors the possibility of selling their securities anytime, quickly transforming them into money. The last characteristic is investor flexibility. Thanks to the secondary market, it is possible to change the composition of your financial portfolio by buying and selling securities based on personal needs or market conditions from Monday to Friday of each week, except for some public holidays. Another interesting question is, how do negotiations work? Well, operations in the secondary market can happen in several ways. With direct search markets, buyers and sellers look for each other directly, without specific rules, and close the deal between themselves. Be careful. This certainly does not mean they are not subject to regulations. Then there are broker markets, where professionals, called brokers, moderate and help find the best offers for those who want to buy or sell. Essential is the quote-driven markets. Based on the quotes provided by market makers, the part that deals with the bulk of the market, they are specialized operators who guarantee the continuous availability of securities to buy or sell. Finally, order-driven markets. In this type of market, the investors place orders establishing prices and quantities. The secondary market is fundamental to the financial system. It determines the price of securities through the meeting of supply and demand, helps manage financial portfolios easily, and supports the primary market because knowing that it will be possible to resell a stock in the future makes the purchase of new issues more attractive. To give a practical example of a secondary market, we can discuss the stock exchange, where most daily transactions occur. The stock exchange is a regulated financial market where various financial instruments, such as stocks, bonds, and derivatives, are traded in currencies. It works as a centralized platform that allows the buying and selling of these financial assets. In addition, there are markets called over-the-counter, OTC, which have different rules. Among these, there is the Forex market, which is the largest market in the world. If you want to know more about them, we could go into more detail in a little video. To return to the keynote, the secondary market is the engine that keeps the financial system moving. It allows investors to buy and sell securities easily, helps them manage their savings, and reacts to economic opportunities or changes. Without it, the financial world would be much less dynamic and accessible. But the stock market is not just a tool for buying and selling securities, but also a system that reflects global economic health. When markets rise, you perceive a strong economy. When they collapse, they represent fears and uncertainties. With globalization and the evolution of technology, today, we can easily access markets with just a few clicks. Doesn't it seem incredible to think you can be part of the growth of great global companies without ever leaving your couch? Platforms like eToro, XTB, and DeGiro, known as online brokers, have changed the lives of thousands and thousands of people. But this is only the positive side and the general functioning. You must keep yourself constantly updated and have impeccable risk management and equally good emotional management. We'll talk more about that later. If you want to get into stock market, you're not the only one. This brings us to the following question. Who are the protagonists of this fascinating world? In the stock market, there are many different players, each with different intentions and purposes. First, it is enough to think of you and me, the individual investors. We buy shares to grow our savings with many different strategies and approaches. Then, there are institutional investors, such as pension funds, hedge funds, banks, and insurance companies which manage huge portfolios. They also act as intermediaries with brokers and banks, facilitating transactions and offering platforms and consultancy services. Finally, regulators such as the SEC in the United States and the European System of Financial Supervision, ESFS, which guarantee the transparency and security of the market, must clearly be present. As far as investors are concerned, not everyone operates similarly. For example, investment duration can help us make important distinctions. The first category in ascending order is that of short-term investors. They operate over periods ranging from a few days to a few months, and mainly traders and speculators who aim to exploit market fluctuations operate in the short term. They often participate in foreign portfolio investments in foreign markets. Then, medium-term investors act over a few months up to a few years, including many retail and institutional investors. Finally, we can distinguish long-term investors by horizons exceeding 5, 10 years, mainly pension funds, insurance companies, and private equity funds with an average duration of 10, 15 years divided between investment and disinvestment phases. For example, a single investment in private equity can generally last 3-7 years, aiming to increase the value in the medium and the long term. For those who don't know, private equity is a form of investment that consists of the acquisition of shares in companies not listed on the stock exchange, intending to favor growth and subsequently obtain an economic return from the sale of the shares or their listing on the stock exchange. Institutional investors, specialized funds, or qualified private individuals generally make this investment. You should emphasize that an investment's duration depends on the financial instrument and the investor's goals, and strategic diversification represents a prudent measure for risk management. An interesting aspect of the market is that very often, even without knowing it, many people think that emotions drive the market, the so-called sentiment, which is, in effect, the market tool that qualitatively measures the attitude and mood of investors towards the financial markets or specific assets. It represents the collective opinion and expectations of market participants regarding the future direction of prices in a particular company or asset. Instead, Institutional investors often rely on mathematical models and algorithms. In contrast, fears or euphoria of the moment influence individual investors. This mix creates opportunities and challenges that you should not underestimate. Now that we have seen on a large scale who the main participants in the market are and, in inclusive terms, how it works, let's move on to a crucial point for this video. How do you choose a stock to buy? Let's get to the heart of it. The answer lies in two words: analyses and strategy. Yes, because choosing an action is not a matter of luck or intuition, but of study and planning. Let's see how to do it together. There are two types of analysis. First, fundamental analysis is the base for those who want to invest with their head, not their emotions. This is about putting the company you are interested in under a magnifying glass. How? Starting from its foundations: financial statements, revenue growth, and industry. Look at the numbers such as the PE ratio, price-earnings ratio, net margin, and free cash flow. In practice, they tell you how profitable the company is and how capable it is of generating liquidity. With this information, you can approximately understand the company's financial health, and to find it, you can use tools such as Yahoo Finance. Then, you have to ask yourself, is the company growing, or is its turnover slowing down? Steady growth is always a good sign. Finally, is it a sector with the wind in its sails, or is it losing ground? Consider the boom in technology companies over the past few years compared to traditional industries that may have lagged behind. However, all this is not enough. It is also necessary to understand how the company positions itself compared to its competitors. Is it an industry leader or a follower? For example, if you want to invest in electric cars, compare Tesla with other companies. Who has the real competitive advantage? Who innovates the most? Now, let us move on to the second type: technical analysis. This is a favorite strategy for traders to capture short-term movements. Now, practical tools come into play, such as RSI, Relative Strength Index, perfect for understanding whether a stock is overbought or oversold. Moving averages, they help you follow price trends over time. And the famous ones, Bollinger Bands, are excellent for identifying volatility and finding the best times to enter or exit the market. To be precise, technical analysis deals with what can be calculated by a price graph and indicators like those we have just talked about, and focuses on identifying the most appropriate time to enter or exit the market. Fundamental and technical analysis are not rivals. Conversely, they are two sides of the same coin, and using them together gives you a much more complete view. However, there is another essential element for choosing an action. You must have the right strategy. Studying is essential, but applying what you've learned is even more important. This is the moment where your personal goals come into play. Are you investing for the long term, or do you want to trade quickly? What is your risk tolerance level? And most importantly, do you have a plan to handle any losses? Yes, because even with the best analysis and the most solid strategy, investing always involves a margin of uncertainty. Market fluctuations, economic crises, and regulatory changes can be unpredictable. So only invest what you are willing to lose, and always consider diversifying your portfolio. In conclusion, study, prepare, and be strategic. Investing is not a game of chance, but a path that requires awareness and discipline. True success comes from balancing analysis, strategy, and risk management. So, selecting the right stocks is like sailing on the open sea. You need a compass, a map, and reliable tools to avoid getting lost in the market waves. Today, we will see stock-picking strategies combining stability, opportunities, and a pinch of foresight. They may help you build a solid portfolio. The first strategy we will discuss is buy and hold, the favorite of legends like Warren Buffett. This strategy focuses on solid companies purchased at a very good price, but with robust foundations that resist time and market cycles. The idea is simple. Buy shares of an undervalued company, hold on to them, and allow time and market growth to work for you. It is perfect for those who don't want to spend hours looking at charts daily but prefer to focus on the long term. Of course, this doesn't mean it's easy. You'll have to evaluate dozens or hundreds of companies before finding a deal. But not everyone wants to put all their eggs in one basket. And this is when the core satellite strategy comes in. Imagine your portfolio like a solar system. The core, or nucleus, is stable and reliable, composed of ETFs or indices, such as the S&P 500. Around, like satellites, you find shares of promising and innovative companies, such as Tesla or Nvidia, which can bring higher returns. It's a great mix to balance stability and growth. In this case, it's as if someone is doing business research for you. Aggressively investing in indices has made several far-sighted investors rich. Indices are one of the safest and easiest options for investing. But what exactly are they? They are baskets of stocks that represent a specific market or sector. Here are some examples. The S&P 500 contains the 500 largest companies in the United States. MSCI World is a global index covering developed countries. And finally, NASDAQ 100 is perfect for those who love technology. Why invest in an index? Index offer diversification. You get exposure to dozens or hundreds of companies with just one investment. In addition, low-cost ETFs that replicate indices have low management costs and do not require large initial sums. For example, betting on the NASDAQ 100 could be the right choice if you want to bet on global technological growth. If you want stability, you can opt for a bond index. Remember, the goal is always to find the right balance between the risk you are willing to face and the return you are looking for. Putting yourself in greater exposure than you can afford is very easy, and you need, as I said before, to have an ironclad basic strategy and an extraordinary mind toward money management. Suppose you are passionate about a specific sector, such as technology or renewable energy. In that case, the sectoral approach might be right for you. Focusing on an industry that you know well or that excites you can give you a competitive advantage because money is not the only thing that moves the world. Passion moves the world too. But be careful. Betting on everything in a single sector can be risky, especially if it faces difficult times. Again, balancing risk is essential here. For those looking for faster movements, the trigger analysis is incredibly useful. This strategy focuses on identifying upcoming events that may impact stock prices. Launching a new product, a major merger, or a company's quarterly results can push the price up or down. If you can identify these catalysts early, you can take advantage of market changes. It is possible to identify this through official news and the economic calendar, but in my opinion, this remains one of the riskiest strategies. However, whatever strategy you choose, one golden rule always applies: diversify. Investing in indices can be an excellent solution to balance your choices. Indices allow you to have an already diversified portfolio, reducing the risks linked to individual companies or sectors. It's like having a safety net while you explore new opportunities. As you will have understood, choosing the right actions is a process that requires method, analysis, and, above all, patience. Don't be in a hurry. Setting deadlines is correct, and investing can open many doors. Still, it's essential not to lose sight of the big picture, and being in a hurry can make you see opportunities where they aren't present. Every decision must be thoughtful and align with your goals and risk tolerance. Wait for the opportunity. Do your analysis. And only invest what you are willing to lose, especially if you are unsure. There is a risk for every opportunity, but with a little study, discipline, and strategy, you can do a lot. Never forget to diversify, learn from your mistakes, and try to avoid missteps. For this reason, in the next chapter, we will discuss the main risks associated with operating in the market. Investing may seem fascinating, but it is also full of challenges. There are risks around every corner, but good news, you can learn to manage them. With some preparation and well-focused strategies, you can tackle any obstacle without losing sleep. But before delving into the risks, it is essential to make some crucial premises regarding the right approach you should have towards the market. It all starts with knowledge. One of the most significant risks is starting without a solid financial education. It is easy to be seduced by promises of quick profits or to rely on advice found here and there, but finance is a complex area where instinct is not enough. You must allocate time for training to manage it effectively. Courses, Books and trustworthy resources are your best allies, and nowadays, YouTube is one of the most used platforms for information too. However, it is vital to have a solid base of knowledge. Only in this way, you will understand essential concepts such as diversification, the risk-return ratio, and how the markets work. Once knowledge is acquired, here comes emotional discipline. Even the best financial plan can fall apart if you let emotions guide you. The fear of losing money during a market decline or the euphoria of a quick profit can lead to impulsive, often counterproductive decisions. This is why it is essential to establish clear objectives and adopt a disciplined plan. Here, too, there is a golden rule. Never react on your gut. Market fluctuations are normal, and with a long-term vision, they become less scary. However, managing emotions alone is not enough. You need to understand risk management. Many novice investors underestimate the importance of protecting their capital. Investing everything in a single company or ignoring the impact of external events, such as economic crises, can lead to devastating losses. This is where portfolio diversification comes into play. Spreading the risk across multiple assets and tools, such as stop losses, limit losses in the event of adverse movements. Having a liquidity reserve also allows you to deal with unexpected events without having to sell investments at a loss. All this is useless if you rely on the wrong sources. Furthermore, scams and gurus who promise guaranteed earnings are commonplace. Trusting those who offer miraculous solutions can cost you dearly. Always check sources and rely on qualified professionals. There are no shortcuts. Financial success results from many informed and thoughtful choices. And finally, remember that time is a decisive factor. Many investors give up too soon, frustrated by the lack of immediate results. But finance requires patience. It is a long-term game where consistency is more important than speed. Define your goals, stay the course even in difficult times, and remember that the market rewards those willing to wait. Having said that, let's discover together what the main risks are and, above all, how we can avoid them. Let's start with the most obvious risk: market risk. Fluctuations are standard. The stock market goes up and down like a seesaw. The important thing to remember? In the long term, that same swing tends to rise. And to remain calm, investing with this vision prevents you from panicking in moments of decline. Then there is the specific risk. This concerns a single company. Maybe you bet everything on a promising stock, but it didn't go well. The solution? It's really about diversifying your portfolio. The more companies and sectors you invest in, the more you dilute the risks. And what about liquidity risk? There are stocks that, although interesting, have limited amounts of trade and can become difficult to sell at the right time. To avoid getting stuck, always try to keep a portion of your portfolio in more liquid instruments and keep a cash reserve aside for unexpected events. Another risk to consider is currency risk. When you invest in foreign markets, you are betting not only on that country's companies, but also on the strength of its currency relative to yours. Exchange rate fluctuations and, in some cases, double taxation can significantly impact your returns. To mitigate this risk, consider more balanced investments and evaluate instruments that protect against currency movements. Investing in the financial market is not for faint hearts, but with the right precautions, you can face it without risking falling. Diversify, invest for the long term, maintain a cash reserve, and above all, stay disciplined. Risks will always be there, but recognizing them and addressing them strategically makes all the difference. Patience and preparation are the keys to turning obstacles into opportunities. 3 practical stock picking strategies. As we mentioned before, here is a little bonus for you. A practical guide on how to invest in 3 different but valid sectors, according to our team. This requires an in-depth and specific analysis for each industry. But if you found this video enriching your knowledge, we would greatly appreciate it if you could give us a thumb up. Thank you for being so supportive. In the next chapter, we will look at the key criteria in the stock selection process across biopharmaceutical, technology, and dividend stocks, as well as a general framework for making more informed investment decisions. In the biopharmaceutical industry, stock selection relies on 3 key fundamental factors. The first aspect is the innovation and development pipeline. For those who don't know, The pipeline is simply the process relating to the drugs in development and the company's ability to obtain rapid approvals. The strength of the company's research and development pipeline must be evaluated. New drugs being tested must be checked for their market potential, but drugs already on the market with expiring patents and potential impacts on the company's revenue must also be analyzed. Then clearly, operational excellence is also a fundamental factor. Another key point is to evaluate the company's ability to accelerate regulatory approvals by examining the integration of quality and regulatory compliance to reduce risks and delays. In summary, what is the company's relationship with entities such as the Food and Drug Administration, FDA, and the European Medicines Agency, EMA? It is also important to analyze the collaborations and partnerships of companies in biopharmaceuticals when evaluating them as stocks to be included among your assets. You must always verify the quality of collaborations with clinical research centers. Examine the management of relationships with contract research organizations, CROs, and analyze strategic partnerships that can foster the development of new products. An example of a successful partnership between biopharmaceutical companies is the collaboration between Johnson & Johnson and Pharmacyclics, which led to the development and commercialization of the drug in 2013 Imbruvica. This partnership has demonstrated how cooperation in research and development can lead to innovative and commercially relevant results in the pharmaceutical sector. Instead, in the technology sector, competitiveness and growth potential depend on three other key aspects. First of all, we find innovation again. In this sector, whoever dominates innovation will dominate the future. To understand if a company is innovating in the technology industry, analyzing investments in research and development, evaluating the presence of patents and intellectual property, and examining the ability to adapt to new technological trends are the aspects to consider. Market positioning is also a decisive factor. To determine whether the company you're evaluating has a strong market position, consider the following factors: measuring its market share in key segments, assessing the diversification of its product portfolio, and examining its strategy for expansion into new markets. And finally, the last key but not least important aspect is financial solidity. Here, market capitalization and cash flow already give you very important information. However, this aspect can sometimes provide a fictitious indication. Remember that several international financial giants have collapsed over the years, causing significant impacts on global markets, such as BlackBerry or Lehman Brothers Holdings, Inc. The latter filed for bankruptcy on September 15, 2008, triggering the global financial crisis. Its bankruptcy in 2008 represented the biggest crack in the history of global bankruptcies. The last example of stock picking concerns companies with stocks that pay dividends. These are ideal for those looking for passive income and stability, especially in the long term. The main decision criteria are history and dividend growth. Checking the consistency and growth of dividends over time and analyzing the rate of increase in recent years are 2 points that help us understand the validity and trust we can give to the company. Looking for a dividend yield of 15 or 20% is useless if you are not paid several times. And this leads precisely to the verification of dividend sustainability. Evaluate the payout ratio, or the percentage of profits allocated to dividends, and examining the company's ability to maintain payments in adverse market conditions. To understand if a company's dividend payout is reliable, our fantastic Yahoo Finance is enough. Look for the cash flow and check 2 numbers mainly. The first is the operating cash flow, and the second is the dividend paid. The latter must least cover, if not be at least double or triple compared to the cash flow. However, there are exceptions, such as REITs, an acronym for Real Estate Investment Trust, companies linked to activity in the real estate market that offer some interesting advantages for investors and must return at least 90% of their taxable income in the form of dividends. As a final tip regarding dividends, make sure that debts are balanced within the balance sheet and annual cash flow of the company you choose to put in your portfolio. This, however, concerns the whole general stock selection process. Regardless of the sector, it is essential to follow a structured approach to choose the best stocks to invest in. The first step is the definition of the objective, clarifying your investment aims and selection criteria that help you identify the key parameters, all the decisive factors and the weight you will assign to them. Clearly, you need to conduct a thorough investigation, research, and select alternatives. It is fundamental to identify companies that meet your established criteria, and thus, your deal. Evaluating each option based on financial data and market trends is another key point. It's not enough to analyze. You have to analyze and compare companies in the sector if you want your research to yield the desired result. Then comes the final decision. It's time to apply the quantitative and qualitative models that you have created, tailored for you to choose the best actions. After you have chosen, regardless of the strategy you apply, comes the phase of monitoring and adaptation. Periodically reviewing choices based on market changes is not going back. Market fluctuations are clearly present and will always be present, and decisions need to be made based on trends. A rigorous process helps you make more informed decisions, reducing risk and maximizing return potential. It's all about strategy. Of course, having talked about all the adverse possibilities, you are probably wondering, why invest despite the risks? Investing is one of the best financial decisions you can make. Why? It is one of the best ways to grow your assets over time. Leaving money still means losing its value due to inflation. And unfortunately, it is one of the roads that can lead to poverty. Always do research. You need to stay informed. With a disciplined approach, you can generate returns, build passive income, and achieve your financial goals, such as a peaceful retirement or a large purchase. Remember, risk is part of the game, but with a good strategy, you can face it and win against the market. Investing in the stock market can be a great opportunity, but the world of finance is constantly evolving. And there is a force that is revolutionizing everything: artificial intelligence. How is the market changing? What opportunities and risks does AI bring with it to the world of investments? If you haven't already done so, subscribe to the channel so you don't miss other content on the world of finance. Don't miss the next video to learn how this technology is transforming the way we invest.